Let us first quickly revise, guys, standard costing, and then we'll start the next topic. So I told you that a standard costing is basically used as a cost control technique. When you say cost control, how does that help you? You are going to set up standards as such, guys, and compare the actual performance with the standards to know what are the reasons as such, guys, for the deviations that are occurring from the standards and take corrective action. So, and it is also considered as a valuation technique. How is it considered as a valuation technique? If an organization follows standard costing, guys, I told you that all the inventories are valued at standard cost irrespective of the actual cost incurred. Now, the primary thing that we learn in this chapter, guys, is how are we supposed to arrive at the amount of variances. Now, ये जो तुम्हारे screen के सामने बेटा, that is nothing but cost control का description, which is, you first set standards and you measure actual performance as such, guys, and then you compare actuals with the standards, and then beta you know what are the variances, and then you should know how are you supposed to account for those variances. Now that we are done with the entire topic, guys, variances are all transferred to profit and loss account. Basically, guys, they transfer to P&L account. Matlab, first everything will be recorded at standard cost, and after that as such, guys, whatever is the resulting difference as such beta will be transferred to P&L account. We also did types of standards, guys. I said this ideal standard and a normal standard first. What's the difference between ideal and normal standard? Ideal is something better that is achievable under the best possible circumstances as such, guys. Now, when I say best possible circumstances, everything should be at the maximum efficiency levels as such, guys. That may not be realistic. That is why we have normal standards. Normal standards is what is achievable as such, guys, during under normal circumstances, considering the existing efficiency levels. And then beta we also did basic and current standards. Basic matlab beta one that is not altered over a longer period. Current is something that is kept updated as such, guys, with the current market conditions. Obviously, guys, your standards should be normal standards, and then they should be current standards. They should be based on the prevailing market conditions. Now, as far as types of variances are concerned, guys, I said we normally divide our variances, guys, into favorable and adverse variance. Anything that is resulting in a increase in cost or a decrease in profitability beta is adverse. Anything as such, guys, that results in an increase in profitability or a decrease in cost as such beta is favorable. From the perspective of controllability as such, guys, we divide our variances into controllable and uncontrollable. Controllable variances are those, guys, which are within the control of the organization. A better performance as such, guys, would have resulted in that variance being eliminated. Uncontrollable factor would be on account of market conditions. There's nothing that you can do about it. I gave an example where if there's a scarcity of raw material as such, guys, and that itself has resulted in an increase in market price, obviously price variance is going to be adverse as such, guys. There's nothing that you can do about it. Usko planning or operational variances we bolte beta, you learn later, so not now. So again, guys, on the basis of elements of cost as such, guys, you divide them into cost variances and revenue variances. Cost mein elements ke basis pe you have material, labor, overheads. I said in order to know how are we supposed to arrive at variances, first you're supposed to know the two basic reasons for variances. For any variable expenditure variance, guys, I told you that the two basic reasons are how are you utilizing that resource, efficiency, guys, consumption, and then the second reason, guys, will be the amount that we are spending on the resource. All right, guys. Now, ये जो first है बेटा utilization of resource, that is efficiency, and the other one is expenditure incurred. For that we took an example of material. Your overall material cost variance, guys, I said any overall variance, guys, will always be standard cost minus actual cost incurred, whether it is material, whether it is labor, variable overheads, fixed overheads, guys. Har jagah we will write standard price into standard quantity minus actual price into actual quantity, or standard rate into standard hours minus actual rate into actual hours, or standard rate per unit into actual output minus actual rate per unit into actual output. Doesn't matter, guys, whether you're doing it for material, labor, or any other variance. It's always going to be standard minus actuals. Your overall material cost variance, guys, which is standard price into standard quantity minus actual price into actual quantity, is segregated into material usage variance and material price variance. Usage variance is on account of the consumption of raw material, guys. Price variance is obviously on account of the money that you are spending on that resource. So usage variance compute karne ke liye beta you're going to compare standard quantity for actual output with actual quantity. That is why beta the formula, guys, would be SQ for AO better minus actual quantity multiplied by standard price. Just go by the word usage. We're talking about consumption of material. That is why it will be SQ minus AQ. And I already told you better that all efficiency variances are always measured at standard price. The difference between standard price and actual price is taken care by expenditure variances. So whether it is labor efficiency, whether it is material usage, whether it is variable overhead efficiency, guys, you're always going to multiply that by standard price only. So it is going to be standard quantity for actual output minus actual quantity multiplied by standard price. After that, guys, material price variance के साथ बेटा would be standard price minus actual price multiplied by actual quantity. I told you guys that depending on the accounting plan that an organization follows is something called a single plan and partial plan. It all decides when are you booking an variance. If an organization follows single plan, guys, it would mean that variances are recorded as and when they occur. If variances are recorded, you do not have to remember these names as of now. I'll talk about this under cost accounting systems also. So if it was important, I would have definitely given a note. So if the variances are recorded, guys, as and when a transaction occurs as such, guys, that is under single plan, material price variance should be based on actual quantity purchased. It will not be based on consumption. So, but material usage variance as such, guys, whether it is single plan or partial plan as such, but it will always be based on actual quantity consumed only. It is only material price variance, guys, that can either be based on consumption or based on purchases. What did I tell you? But by default, if they give us details of purchases, what will you do? You will take actual quantity purchased into consideration. If details of purchases are not given, guys, obviously it is actual quantity consumed. If they do not give details of purchases, you do not even have to use the word actual quantity consumed as such, guys. Just write AQ. There's no difference between actual quantity consumed and actual quantity purchased. Now, your material cost usage variance as such, guys, will be further segregated into two categories called as sub-usage variance and mix variance. This classification, guys, arises only when you have more than one type of raw material. More than two, guys. More than one, huh? We're not talking about personal lives as such, guys. So here, if you have more than one type of raw material as such, guys, then you will have sub-usage variance and mix variance. The change in total cost as such, guys, can not only be on account of change in quantity, it can also be on account of the proportion in which the materials are being mixed. If you use higher quantity of a material as such, guys, that is more expensive, it is going to result in an adverse variance. If you use lesser quantity as such, guys, of the more expensive material, it might be favorable. So this is where as such, guys, sub-usage variance measures only change in quantity. Mix variance measures change in proportion. For this, we have introduced a new term called as revised standard quantity. RSQ is total actual quantity in standard mix. Standard mix, price क्या है? It is total actual quantity, guys, in standard mix. So to arrive at your sub-usage variance, guys, you will write SQ minus RSQ multiplied by standard price. To arrive at mix variance, guys, you're going to write RSQ minus AQ multiplied by standard price. One is SQ minus RSQ into SP, the other one is RSQ minus AQ into SP. So when you take SQ minus RSQ, guys, both of them are in standard proportions, but one is standard quantity, the other one is actual quantity. This is where this measures only variance on account of quantities. When you write RSQ minus AQ as such, guys, both of them are actual quantities, but one is in standard mix, the other one is in actual mix. So this is where you're arriving at variance on account of change in proportion, not on account of change in quantity. Is that clear, kids? After that, guys, sub-usage variance is also known as yield variance. After that, as such, beta, we moved on to your labor variances. Just like material variances, guys, इतना याद रखना बेटा for material variances that standard quantity for actual output is what? Something that you will have to compute. So they might give a standard relation. Using that standard relation and actual output as such, guys, you're supposed to arrive at standard quantity for actual output. And if at all there is a requirement to compute actual output, do not ever use actual quantity. You're only supposed to use standard quantity for actual output. It is standard quantity for actual output that is related to actual output as such, guys, using your standard relations. Are we clear about this? You made this mistake in a couple of questions, guys. Always use only standard quantity for actual output. Reverse calculation bhi agar hai to. Now, After material variances, guys, labor variances, overall labor variance as such, guys, is still the same. You're going to write standard cost for actual output minus actual cost incurred. So that will be standard rate per hour into standard hours minus actual rate per hour into actual hours. Actual hours for overall labor cost variance will always be actual hours paid. It will not be actual hours worked. क्योंकि खर्चा तो पूरा ही हो रहा है बेटा. You will have to take actual hours paid into consideration. You will divide this overall labor cost variance, guys, into labor efficiency variance and labor rate variance. Efficiency variance obviously better measures variance on account of the efficiency of the employees as such, guys. This is where we compare standard hours for actual output with actual hours worked. To measure the efficiency of the employees, you're always supposed to take actual hours worked into consideration and not actual hours paid. Is that clear, guys? Himal. So that will be standard hours for actual output minus actual hours worked multiplied by standard rate per hour. In order to arrive at labor rate variance as such, guys, you're going to compare how much were you supposed to pay them as per the standards, how much are you actually paying them as such, guys. So I'll be standard rate minus actual rate multiplied by actual hours paid. Are we clear, guys? If at all there's a difference between actual hours worked and actual hours paid as such, guys, for that there'll have to be clear cut information given in the question. Only if they specify there is idle time. If they do not specify, there will not be any idle time. So in case they specify that there is an idle time as such, guys, that idle time will be measured as actual hours worked minus actual hours paid multiplied by standard rate per hour. Remember, this is abnormal idle time. Normal idle time, guys, will be adjusted to your rate per hour or number of hours. You will have one question under additional questions as such, guys. Just my normal idle time hai, check karna. So if it is abnormal idle time only as such, guys, you will have to consider like this. So once this is done, guys, your labor efficiency variance is again further segregated into labor sub-efficiency variance and labor mix variance, also known as gang composition variance. So when you say labor sub-efficiency variance, guys, we are talking about variance on account of change in total number of hours. When you talk about labor gang composition variance as such, guys, it is on account of change in proportion of the employees. So this bifurcation of efficiency variance into sub-efficiency and mix arises only when you have more than one type, one grade, one class of labor, not more than one employee. Only if they specify that you have more than one grade of labor, beta, all of this will come. If the question says that a week is consisting of 40 hours, what will that mean? Actual hours worked as such, beta, would be 40 hours unless otherwise given. If they give this abnormal idle time, you will have to deduct that abnormal idle time and then arrive at the balance amount. Is that clear, kids? Now, क्या हो गया ना labor में इतना ही था ना? Yes, guys. After labor variances as such, guys, we moved on to variable overhead variances. हाँ निकल रहे. Variable overhead variances that we have learned, guys, are all based on labor hours. So your overall variable overhead variance, guys, will still be standard rate into standard hours for actual output minus actual rate into actual hours. That is still standard cost minus actual cost. Under overheads as such, guys, it's pretty common for them to give details of output, guys, and you computing variances on the basis of output. That is why from here better we've also written standard cost as standard rate per unit multiplied by actual output. That is still standard cost only. So you'll write SR per unit multiplied by actual output, and from that you will deduct actual overheads incurred. Your overall variable overhead variance as such, guys, is segregated into variable overhead efficiency variance, कौन है रे volume, fixed overhead है. Variable overhead efficiency variance, guys, and expenditure variance. Is that clear, beta Shreya? ये लोग सुनेंगे सब यही same revision video देख बाद में. So when you say variable overhead efficiency variance, guys, किसकी efficiency measure कर रहे हैं अपन? Labor. It is still the efficiency of the labor only as such, guys, that is impacting the total amount of variable overheads that you're going to incur. There's no efficiency as such, guys, of variable overhead. Efficiency arises only for labor, guys. So that is why, guys, the standard hours and actual hours as such, guys, for both labor as well as variable overheads as such, guys, with or without meditation are the same. So when you say variable overhead efficiency variance as such, guys, it will be standard hours for actual output minus actual hours multiplied by standard rate per hour. ये standard rate per hour, guys, wage rate नहीं है. It is variable overhead rate per hour. How will you compute that standard rate per hour, guys? It will be equal to budgeted overheads divided by budgeted number of hours. That is how, guys, you're going to arrive at standard rate per hour. Are we very clear about this? Next beta, variable overhead expenditure variance guys will be standard rate minus actual rate multiplied by actual hours. Now do not forget, we did not come across this any of the questions, but it is pretty common in CA final. I said guys, variable overheads के लिए number of labor hours as such guys would always be actual hours worked, because you incur variable overheads as such guys only when the work is being undertaken. So whether it is variable overhead efficiency or expenditure, या दोनों के लिए बेटा you're going to take only actual hours worked into consideration. There's no such thing called actual hours paid. There will not be any sub bifurcation guys under efficiency variance here. It ends at this point only. Now what is the most important point that you're supposed to remember in case they do not give us details of time, number of hours as such guys? You will not be able to segregate the overall variable overhead variance into efficiency variance and expenditure variance. You will have to directly arrive at overall variable overhead cost variance by writing standard rate per unit into actual output minus actual cost incurred. Are we clear about this? After this beta, we moved on to fixed overhead variances. I said fixed overhead variances guys slightly differs in terms of what the amount of expenditure is supposed to remain constant as such guys, irrespective of the actual output manufactured. In spite of that as such guys, there can be a variance as such guys. So whatever fixed overhead variances that we have learned is on account of absorption costing. That is, if an organization follows absorption costing, your overall fixed overhead variance is still the same guys. It is standard cost for actual output minus actual cost incurred, exactly the way beta that you have computed under or over recovery of overheads in overhead chapter. The difference being, वहां पे बेटा overheads absorbed were all based on actual activities. यहाँ पे I said that overheads absorbed should always be based on standards. You will either write standard rate per hour into standard hours for actual output, or you're going to write standard rate per unit into actual output. That is absorbed overheads. To compute that, they should give us budgeted output, they should give us actual output. Using budgeted details beta, you're going to arrive at standard rate per unit. Once you get that standard rate per unit as such guys, you're going to compute absorbed overheads as such guys by writing standard rate per unit into actual output. Is that clear guys? Your overall fixed overhead variance, which is absorbed overheads minus actual overheads beta, is segregated into fixed overhead volume variance and fixed overhead expenditure variance. I gave multiple cases in the class as such guys to understand how change in volume is affecting overheads absorbed. So that is what results in volume variance. And then expenditure variance guys is directly on account of change in expenditure. So for volume variance as such guys, you will write absorbed overheads minus budgeted overheads. For expenditure variance, you're directly going to compare budgeted overheads minus actual overheads. Now one thing to be remembered, even if details of time is not given, we will be able to compute volume variance and expenditure variance. दोनों के लिए time की जरूरत नहीं है. Are we clear about this? Your volume variance guys, कैसे याद रखोगे? Volume is absorbed minus budgeted, and then expenditure is budgeted minus actual. Are we clear about this? Volume variance guys is further segregated into three things guys. There is calendar variance, there is capacity variance, and then there is efficiency variance. I said your volume can change, first factor, on account of change in number of working days guys. If you were supposed to work for 25 days and you've actually worked for say 27 days, is it going to be favorable or adverse? Prima facie favorable. You do not have to worry about whether there's actually an increase in output or not. That will all be taken care by capacity or efficiency variance. So in case instead of working for 25 days, you worked for 27 days guys, your calendar variance will be favorable. Capacity variance guys measures how many hours were you supposed to work for, how many hours did you actually work for. But this is all for actual working days, not for budgeted working days, because under calendar variance you've already shifted from budgeted working days to actual working days. So capacity variance as such guys is about comparing number of hours that you worked with the number of hours that you were supposed to work guys as per the budget. Is that clear? And then guys, efficiency variance beta is the number of hours that you've worked for. Did you work efficiently or not? Huh beta? Yeah. Should I talk? That is why guys, to compute calendar variance guys, the first thing that we do as such beta is compare actual working days with budgeted working days, multiply that by standard rate per day if you're computing it in terms of number of days. If you're not doing it in terms of number of days as such guys, you've introduced a new term beta called as revised budgeted hours, RBH. RBH as such beta are budgeted hours but for actual working days. So calendar variance can be computed as RBH minus BH multiplied by standard rate per hour. Capacity variance compute करने के लिए बेटा it is AH minus RBH multiplied by standard rate per hour. I repeat, AH minus RBH. If at all there are no details given regarding number of working days, guys, then it is AH minus BH. क्योंकि BH and RBH as such, guys, both of them as such beta would exactly be same. Abhi clear, guys? And for efficiency variance as such, guys, you're going to write standard hours for actual output minus actual hours multiplied by standard rate per hour. Are we clear about this? This was a classification, guys, of fixed overhead volume variance into efficiency, capacity and calendar. Now, in case a company follows marginal costing as such, guys, which I've discussed the other day, I said volume variance will not arise. The only variance that will arise as such, guys, is expenditure way. There's no absorption of fixed overheads as such, guys. If there's no absorption, there's no volume. You will directly arrive at expenditure variance. That is in case as such, guys, an organization is following marginal costing. So on my guys, under variable overheads and fixed overheads ke combined questions as such, guys, we have come across a question which asked us to compute production volume variance and overhead expense variance. You remember that? This is where details of time were not given as such, guys, and also actual overheads incurred ka bifurcation was not given. How much is variable, how much is fixed. So I said, guys, in questions like that as such beta, production volume is still fixed overhead volume variance only, but overhead expense variance as such, guys, is a sum total of all the other variances. That will include variable overhead efficiency variance, that will include variable overhead expenditure variance and fixed overhead expenditure variance. All of them put together as such, guys, will become your overhead expense variance. Yaad aaya kuch? When will you use this? Requirement will be very clear beta, that you have to compute production volume and overhead expense variance, and plus actual overheads incurred will not be bifurcated, guys, into variable overheads and fixed overheads. Is that clear, guys? Last mein beta we did revenue variances. I said revenue variances prima facie, are they a part of your syllabus? No. But anyways, guys, revenue variances are very simple. You're supposed to compare what? Because you're dealing with revenue item as such, guys, instead of writing standard minus actual, I told you that you're going to write actual minus standard. But instead of using the word standard, we use the word, just like material variances, ulta likhna hai bas. So overall, and selling variances, guys, sales variances can either be computed on the basis of selling price or they can be computed on the basis of margins. In case an organization follows marginal costing, margin would be contribution per unit. In case an organization follows absorption costing, margin would be profit per unit. So guys, यहाँ पे बेटा, in order to arrive at your overall sales variance, you're going to write actual price into actual quantity minus budgeted price into budgeted quantity. This overall sales variance as such, guys, will be segregated into sales volume variance and sales price variance. Volume variance beta will be actual quantity minus budgeted quantity multiplied by budgeted price. Price variance as such, guys, will be actual price minus budgeted price multiplied by actual quantity. Are we clear, guys? I said volume variance is also segregated beta into quantity variance and mix variance. Quantity variance further segregated into market size, market share variance as such, guys. कुछ याद रखने की जरूरत नहीं है, ठीक है? You already have a lot on your plate as such, beta. You have to remember so many things about so many people. इसको क्या पसंद, इसको क्या पसंद. So you can forget about this. So I was talking about everyone. Correct, Patil? Next one is such, guys. If the same sales variances are computed on the basis of margin, guys, you're going to replace the word price with margin. Baki sabka sab same. But what is the most important point that you're supposed to remember here? Perfect. Both actual margin and budgeted margin, guys, will always be computed on the basis of standard cost. You will not consider actual cost anywhere. Reasons? The difference between standard cost and actual cost is already computed under cost variances, plus sales department is not responsible for deviation as such, guys, from standard cost. So their performance should not be evaluated on the basis of actual cost. Are we clear, guys? Everything left? All done, right? खुद के लिए तालियां मान लो, बड़ा अच्छा रिवाइज कर लिया. All right, guys.